from the previous video, we covered the myth of stock picking or stock selection, and we determined that there was so much data that proved that the majority of managers don't outperform the market. They very much underperform the market, and the amount of wealth that is lost to active stock picking. But what we determined also was most people would say, I'm not going to pick an average fund manager, I'm going to pick an above average fund manager. And we determined that most people would use a history or a track record of the past performance to determine which managers to choose for their investments for the future. This relates to the second myth, track record investing. The definition is the use of performance history or a track record to determine the best investments or the best managers for the future. And the myth is that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. So we determined we needed to look at a longer time period to see what the track record of a manager was. And we chose a 10-year period of time, from 1991 to 2000. Now you can use any 10-year period, but for instructional purposes we're using 1991 to 2000. And as we can see, the top 30 funds outperformed all funds average, the S&P 500, and the CRSP 1 through 10. Now the CRSP 1 through 10 again is the Center for Research and Securities Pricing out of the University of Chicago, and this is the total market itself. So you can see that the top 30 funds did exceptionally well in outperforming the market. Now what's interesting is, though, and mutual fund companies typically don't want you to know this, there was only 726 mutual funds to choose from that had a 10-year history at the end of 2000. So let's see if these top 30 funds did as well the second 10 years. And keep in mind, most people were buying these top 30 funds in January of the next year, and most advisors and financial planners were recommending these top funds. So let's see if these top funds outperform the market. And as we can see, from 2001 and 2010, the top 30 funds underperformed all funds average, the S&P 500, including the total market itself. But what's interesting is, though, look how many more funds there were to choose from at the end of 2010 that had a 10-year track record, 3,732 funds. Here's another interesting point. There were 27,000 funds available at the end of 2010, only 3,700 had a 10-year track record. But here's the problem with this study itself. This time period's too long. Most mutual fund investors only hold their mutual funds for 3 years. So we're looking at a 5-year window now. We reduced the time period to look at a 5-year window from 2001 to 2005. And as we can see, again, the top 30 funds did highly outperform all funds average, the S&P 500, and the CRSP 1 through 10, which is the total market. It didn't outperform, however, the CRSP 9 through 10, which is the microcap or small cap stocks. This is important for later discussion in this presentation. The total number of funds available, 5,236 to choose from that had a 5-year track record. So again, which mutual funds do you think most people were buying and recommending at the end of this time period? It looked exactly like this list. Did they outperform the market? From 2006 to 2010? No, it didn't. It didn't display exceptional value worth the money that you paid to be in these investments. It did outperform all funds average, but the CRSP 1 through 10 and the CRSP 9 through 10 had underperformed. Not only that, once you found out that it underperformed the market itself, there were even more funds to choose from. So what this tells us is a manager's ability to pick stocks in the past has zero correlation with his or her ability to do so in the future. In other words, a manager's ability to pick stocks in the past has nothing to do with his or her ability to do so in the future. So track record investing, or looking at a manager's past performance, is not the best way to determine how to invest your money moving forward. Now let's move on to myth number 3, which will be market timing, in the next video.